Good night. It's the 9th of November 2025. That took me filing out there to leave a bit of space. This is about the financial reporting on an entity, which could be a farmer, a shoe shop, a sole trader, or a company. It's all the same principle. How do they count up? Well, when they do all the ledgers and count up all the pluses and minuses and add up all the receipts, they do what they call a T account, which has to balance with each trader or each supplier. Now, we're not going to go into that because for the ordinary man, he mightn't be keeping that kind of a thing. And there's also a trial balance, which makes sure your figures tally before you commit them to the proper format of the profit and loss account. Now, to report on an entity, we call a company an entity, whether it's a farmer or a shoe shop or a company or whatever. To do that, you have the profit and loss account, and that's what you did, your performance over the year. It could be the 1st of January to the 31st of December. It used to be the 6th of April to the 5th of April, was it? Or was it the 7th of April to the 6th of April? They've done away with that. There was a lot to be said for it too. One of the problems with the 1st of January or the 31st of December being the closing date is sometimes staff have to go and take stock on New Year's Day. Yes, there are big companies where the auditors and that, or not so much the auditors, the accountants, the in-house accountants have to come in and do the stock on the last day, the first day of the year, because you have to have the opening stock. Anyway, you have the profit and loss account, often called a trading profit and loss account. So that's your performance over a year. The next thing you have is a balance sheet, and that's a snapshot of how you're doing at a particular moment, usually at the very, very end of the trading year, which will be the 31st of December in this case. And the profit and loss account and the balance sheet will be on the same date, same period. Okay. Next thing is a cash flow statement, because you could have all these assets, but there might be no cash, and that would leave damage your going concern principles. You know, you have to be a going concern. So we're not just going to go near the cash flow statement now. I hope to do the profit and loss account here and do another video on the balance sheet. Now, so how does the profit and loss account work? Well, the first thing you have at the very top is sales, often called turnover or revenue. That's the total money you took in. And here we say it's John Brown, 400,000 euros. Now, the next thing is there'll be something taken out of these sales directly, which will be purchase returns. So it's a shoe shop. So you sold for 100,000 worth of shoes, but there was 5,000 of them returned. You know the way you can go back into these shops and they'll take it back. That's purchase returns. That'll be big in places like Dunnes Stores and that, where they be bringing back clothes, might bring them home and wear them to a wedding or something, and then bring them back and say they didn't, that kind of a thing. So they won't do it for don't know where. I wonder why. But anyway, purchase returns. So when you take the amount of shoes brought back to you, you take that from this, and you have the actual net sales of 395,000. Does that make sense? So that's your sales, and this is the purchase returns, stuff brought back to you. So the actual sales is 395. That's the way to do it. Okay. Now that'd be lovely if you could put that in your pocket and you had 400,000, but of course it costs money to sell this stuff. So the first thing you have is the cost of sales. This is a wee bit always like this. Do you see that? So the first thing comes into the cost of sales is your opening stock, because you have stock on the first of the period, and that stock costs you money. So you put it out here, it's 100,000. So you're selling shoes, you have 100,000 worth of shoes in the store, okay, and on the shelves, on display. So that's 100,000 that you would have paid for them to sell them. Now, that's that. The next thing is plus purchases. Now remember, you're taking the cost of sales out, and I should write the word less. L-E-S-S. So now you have the opening stock at 100,000. Now plus the purchases. So the purchases is 350,000. So you're going to be buying in a lot of shoes during the year. If you're a big hardware store, you're going to be buying in a lot of stuff. The lorries will be coming every day. And if you're a farmer, you'll be going out to the mart and you'll be buying a couple of sturks, a couple of cattle, right? Doesn't matter. That's all a cost of sales. So the plus purchases is 350,000. Now you see here now we already have 450,000 of cost of sales, and we only sold 400. So now the next thing you have is sales returns out. That would be where you got a batch of shoes and they were wrong, or the soles was off them, or they were bad quality. If say you have a certain standard there and you get a lorry load in and there's a certain amount of it wrong, you send it back to the supplier. It's up to him to get it right, okay? Also, some of these purchase returns might be faulty shoes. There might be a pair of them and there might be a number 11 and a number 12. So they go back. So they'll actually go back here, you see, to the supplier. You see? And they'll not be the same because you might be rejecting a load of cement because they're all hard or something, and you never let them go out to sale. So after the sales return outward, that would be back to your supplier. Whereas this is the purchase returns in, that'll be your customers bringing back stuff that they're not happy with. Okay, so that's it. In this case, it's 6,200. 6,200. So that's taken out because you're not paying for this. You are not paying for this. That's your suppliers have to pay for it. You got the load, you sent it back to them, you're not paying for it. Okay, so you have that now. So that's purchase returns out. This is often called returns in. You see I have the word in written here. So now when we take our sales, our net sales of 395, and we take our cost of sales, which is our opening stock, which is our purchases, what we bought, less returns out to suppliers, we have 343,800. 343,800. Okay. Now it's getting looking a wee bit better. So the next thing then we have is less closing stock. Less the closing stock. See? And the closing stock is 120,000. The closing stock is 120,000. So you have the opening stock and you have the closing stock. And you can see in this case it's 20,000 different. It doesn't have to be the same. You wouldn't have the two the same hardly ever. But if it did, it doesn't really matter. Now, when you then come along and calculate that, by taking out your closing stock, because you still have that closing stock. That's your opening stock for the next year, for the next trading period, your closing stock. So that's your opening stock for the next year. So that there is less closing stock. So this is taken from this. This is your cost of sales, and this is taken because this is not a cost of sales. This is your closing stock. And when you add them two up, you get a figure. I just write it in here, folks. So I've just written it in here, 323,800. This is the cost of sales, less what you have left in the store or in the shed or what cattle you have out in the field. That is taken out. And then your figure is 323,800. And you take that figure, the cost of sales, from your net sales, and you get your gross profit, which is 71,200. 71,200. Okay. Sorry, it's a bit awkward here to twist around, but still it doesn't matter, so I'm sure you understand. So now just to do it again, your sales is 400,000, your purchases, returns, shoes that people brought back into you. I don't like them. You have some of them a size 10, another size 11. Oh, we'll send them back, right? Give us them. Give you a refund. give them a refund. And so net sales is 395. So you sold 395, simple. So then you have less the cost of sales, opening stock. Read this like that, folks. I got it a bit bogus because I need it spaced out here. Opening stock, you had 100,000 in the store, or you had 100,000 cattle, or you had 100,000 whatever, plus purchases. Because this is a cost and this is a cost. So you add the two together because it'll be the total cost plus purchases, unless sales are turned out. So that's money going back to your supplier. If you're a big company like Chadwick's or Fraser's or some of them, you'll be sending back a certain amount of stuff to the supplier, and they'll have to figure that out on their account and take it off your total bill. So you then find the fact that your cost of sales is 343,800. 343,800. Okay. Now, but this also has another thing. You have 120,000 in the store. You have 120,000 on the land or in the store or whatever, right? And that so is taken from the total cost of sales, because you still have that. You're not out that, it's not a cost. I'm looking funny in this, I know that. I can't help it because I'm cooked up here. So that then gives you a total cost of sales of 323,800. That's that less that. And that's your cost of sales. And when you take your 323,800 from your 395,000, you get a gross profit of 71,200. Okay, we're on 11 minutes now. I'm going to go to a new sheet. So this is the very same set of figures, except I've taken out the returns, the purchases returns and the return to suppliers. And here we see now that our sales is 395. Our opening stock is 100,000. Our purchases is 343,800, giving us 343,800. So sales 395, no 100. Cost of sales. So the sales are less cost of sales. What did those sales cost us? And we have the opening stock. That's a cost. We could have sold them, but we didn't. We kept them on and we sold them out to customer. We could have got rid of them or had a big auction or something, but no, we kept them for the new year to be selling. And then so it's 100 plus the purchases, what we bought in. So you add the opening stock and the purchases together and you have 433,800. You see that? And that's bigger than that. So that would be a loss if you left it like that. But then you have to take from this the closing stock. You take from this the closing stock, because you still have the closing stock in the shed or on the land or whatever. And when you take that out, then you get this figure here, 323,800. And you can see then that that's your cost of sales. So now here's the sales, here's the cost of sales, and if you take, I'll just get my €4 calculator out of these. So I went top shelf. So if you put down 395, 0 minus 323,800, 323,800, we get 7,120, and that's the same here. You see, so what I've done here with this one is I've taken out the purchase returns to keep it simple, and the sales returns back to suppliers. And then we can now write in our answer, 71,000, gross profit, 71,200. Right? So that's our gross profit. Now this has nothing to do with rent, rates, telephone account, wages or anything else. This is just your gross profit. Sometimes they call it the operating profit. Put any name you wish. I just want you to understand it now. I hope that maybe some of you do understand this. There'll be people watching me here knows this inside out. But anyway, that's the story. Now have you that? Is that relatively simple? Your John Brown, whatever it is, shoe shop, sales, 395,000. Cost of sales, put a line under this. So you take away the cost. How did those sales cost you? Opening stock is 100,000. So you sold all them. So they're cost. Purchases, you bought 343,800. Total cost of sales is 443,800. The closing stock, what's left, what you have left, which is yours, you can do what you like with it, is 120,000. Take the 120,000 from this 323,800, and that gives you your gross profit of 71,200. So when a farmer has a couple of good cattle and the price is good, and he's wondering, should I sell before the end of the year? Maybe if I do that, I'll be paying more tax. Maybe if I keep them till next year, I mightn't have as much tax. Or I might be buying a new tractor or something like that. What should I do? Well, if we look at John Farmer here, in a simple case, this is a bit wobbly. You have sales, 20,000 for simple. We'll forget about purchase returns and sales returns. Sales, 20,000. The cost of sales, 10,000. 10,000. Opening stock, nil. Purchases, nil. Closing stock, nil. So he must have bought those 10,000. These could be, we'll say 10 bullocks. You see, I've written up here. Can you see that? 10 bullocks. So he must have went out in February or January or February and bought 10 bullocks. And the cost of 10,000. So he grazed them over the summer, right? Now, sorry. No, I'm wrong there, just to hold with me. He sold 10 bullocks, he got 20,000. The cost of sales is 10,000, right? So it's a bit out of line. So his opening stock is 10,000. So therefore he had those cattle coming in as immature stock. He had those cattle at the beginning of the year. And he sold them, let's say, now in November. And he got 20,000. He paid 10,000. He bought nothing. And he had nothing left. He sold the whole lot. He's nothing. Cleaned out. He's not going to winter any. Now, his gross profit then is 10,000. Do you understand? Let me just go over that again. This farmer sold 20,000 worth 10 bullocks at 20,000. He has no other cattle at all, nothing at all. Just say that's all. Sold 10 of them, 20,000. They made 2,000 apiece. The cost of sales was his opening stock. So he had those coming in. He had those at the beginning of the year. And that means they are counted as a cost of sales. He bought nothing and he had no closing stock. So his profit is 10,000. Do you get the point? So he had these cattle on hands at the beginning of the year. He had these cattle on hands at the beginning of the year. So that's how the stock works. If he had nothing on hands at the beginning of the year, he'd have had to buy 10,000 worth. He'd have had to buy them. and then as he sold all, he has no closing stock. Do you understand that? Sales, cost of sales. The cost of sales can be the stock at the beginning, or it can be the purchases, he could have bought them, or it could be a mix of the two. And then the closing stock, if he had a few left over, they have to be taken into account. But in this simple case, he sold 20,000, 10 bullocks for 20,000, and he had them coming in at the beginning of the year, so they were worth 10,000 at the beginning of the year. Now, how can there be a difference in 20 and 10? What am I for time there? Oh, we're all right. 20 and 10. They grew up. He fed them meal and grass, and it was a good year. So that's how his cattle performed. They made 10,000 for him over the year. Okay. So the gross profit is 10,000. Now, we'll take a slightly different scenario here. In this case, he sold 15,000. He didn't sell them all. He only sold, we'll say maybe 7 of them or whatever, and they made 15,000. That's what he got off the mart. 15,000. The cost of sales is, so we'll keep it the same. The cost of sales is opening stock, right? O-S. Opening stock. So he had 10,000 at the beginning. He sold so many, not them all, and he got 15,000. So, how can there be a difference? Well, we'll say he kept a few. Then his closing stock is going to be 5,000. Are you with me? His closing stock is going to be 5,000. He still has them in hands. So you take the closing stock from the sales and you get 10,000. So it's the same thing. Whether he sold them all for 20,000 and just had the opening stock of 10 at the beginning and had no closing stock or no purchases, is the same as if he only sold 15,000 worth. He kept a few back. The cost of his opening stock, he had them before the beginning, was 10,000, and therefore he had to have a closing stock of 5,000, and the 5 from the 15 leaves the 10. So it doesn't matter whether you keep them or not. If you keep them, they're counted at their value at the end of the year, and if you sell them, you have the actual value. And then if you keep a few, well, they'll be the opening stock for the next year. Have I made that relatively clear? Okay, we'll see you back soon. That's the first bit of it. Begin to sound like a schoolmaster. Good luck. See you.